I guess if I could create a picture here for everyone. As we know, gold has really been bouncing off its lows. So much so that mainstream media has started to talk about gold again. I've worked with Jim Cramer, alongside Jim Cramer now for the past 4 years, never spoke about gold. All of a sudden, he's advising people to buy gold, loving gold. We have billionaires like Sam Zell, never bought gold before. For the first time, they're buying gold. We have central banks that also never bought gold, buying for the first time. Recently, China adding to their reserves for the first time in over 2 years. So what is all this telling us? Who wants to kick it off? Frank?
It's test. It's the great unwind. This QE unwinding is so disruptive to the stock market. And you can see that when QE3 came in, all of a sudden gold was not moving with this debt creation. And now it is. And we also have the trade wars and the concern that rates are peaking and they're going to fall. The dollar will fall dramatically. And like in a blink of an eye, gold will be $1,500, $1,600. But I think it's just over $200 trillion of global debt is the real significant factor. Now, for gold directly, it's supply and demand. We have peak gold. We've seen presentations on it. I've been writing about it for 18 months. And I think that supply restriction is showing up in the marketplace.
Peter Hug, is it safe to say, is gold back?
Not yet. I mean, it never went away as far as I'm concerned.
Okay, Peter Schiff, go ahead. No, go ahead.
We got two Peters on the panel?
Two Peters, so.
All right, well.
Peter S.
All right.
Go ahead.
But, you know,
okay, go ahead, Peter.
the professional investment community, of which I guess I'm involved on the fringes, but there's a natural, skepticism of gold. In fact, I was watching this guy on CNBC just last week who was a regular. The guy was, he did his undergraduate at Princeton. He has a MBA from the Wharton School. He's a CFA. And he was asked a question about gold because gold was making a new high for the year. And the other person who was, hosting the show said, "What do you think about gold?" And he goes, we don't even look at gold because after all, gold doesn't even have any uses as a metal. And, this is the mentality. People think not only is gold worthless as an investment, it doesn't even have any uses, despite the fact that gold probably has more uses than any other metal, not to mention the fact that you can make jewelry out of it. I'm wearing some Menet cufflinks myself. And, as much as my wife loves her Menet jewelry, I like it even better because at least I'm not wasting money when she buys it.
Peter Hug?
I think there's a bit of a fallacy out there. Everybody's looking for gold to go to $1,900, $2,000, could go to $4,000, and I certainly agree that that's possible given some of the geopolitical and some of the macro events that are occurring on a global basis. But what people fail to see is that if you looked at gold in 2009 and compared it January of 2009 in Canadian dollar terms and January of 2019 in Canadian dollar terms, you would have received a 7% annualized return every year.
Wow.
In gold. But nobody looks at that. So that's not a bad investment. In U.S. terms, it's been a little lower. It's been about 4.5% over that 10-year period. And then there's going to be spikes in between that 10-year period. Now you've got to determine from your own psychological perspective, are you a trader or are you an investor in gold? Now, if you're a trader in gold, you've had multiple opportunities over the past 5 or 6 years when gold peaked first in 2011 to today to be able to get in and out of the market, at times getting 20-30% returns over a span of 18 months. So, I'm not one of the guys that says gold's the end-all, be-all, and you get all glitter-eyed about it. It's an investment. Sometimes it produces a better return than other investments, and sometimes it produces less of a return. But over a longer period of time, just over the last 10 years, when the stock market has gone up, gold has still returned 7% if you're a Canadian investor.
And just on that point, Peter, because yes, gold has been making highs in Canadian terms, Australian terms, but other investors are saying, well, that's great, that's nice, but how does that help me? How can I make money off of gold?
Well, as a Canadian investor, you could have bought gold 10 years ago, you would have earned 7% on your investment every year. I think that's a reasonable return. So I'm not sure what the question means. There are various methods to investing in gold. Obviously, you can get into gold mining shares, you can buy gold jewelry, you can buy physical gold bullion, you can buy ETFs. If you're more aggressive, you can trade in the futures and the options markets. So there's a variety of instruments out there for you to take advantage of. It's really a matter of what your risk tolerance is and what your time horizon is. But gold as part of your portfolio is something that has proven to be an excellent asset, at least over the last 10 years.
Roy?
I think the answer to your question is somewhere between what Peter was saying about the fact that people don't really understand gold's natural properties, and I hope we get a chance to talk about that later, but to be more specific, like in terms of the trading signals. So I come from the school of thought that gold is money, which means that there's only one kind of money, the money that's endowed by nature, and that's gold. And if you were to say, look at the price of gold in dollars, in US dollars, considering that interest rates have risen a lot, far beyond what I thought they could, considering all the debt that has been issued, gold's very high, like 1,300 USD for a 2.5% US dollar rate is something I didn't think would happen. I would have thought gold would have declined to 1,100. And so what this comes back to is what Peter was saying, that there are only real interest rates since the financial crisis erupted, and all this extraordinary monetary policy that has never been thought out, never been studied, no books have been written about QE or TARP. It's only been removed in the United States. They're still in the process. The Federal Reserve balance sheet is still massive. It's like $4 trillion or something. But everywhere else around the world, they're still engaged in extraordinary quantitative easing or monetary debasement, essentially. And I think the reason that you're seeing gold rising or at or near all-time highs in most of the world, 196, there are 196 currencies, just so you understand, is because of that. Because at the end of the day, the market still is seeking a safe haven to be money, and most of the world's currencies are still not offering a risk-free rate, which compensates for inflation. So as it relates to the trading signal, I would say if the Federal Reserve stops raising rates and starts to guide downwards to reduction of rates, then gold should, in US dollar terms and all other currencies, should do very well this year. And it looks like that trade is setting up. I tweeted about that the other day. It does look like a new bull market is starting. If, however, we see the other countries begin to raise rates and Powell stays on the course that he's on, and this new Trump economic engine continues, which may very well be possible. We've been living in an era with cheap money, service economy investments, low capex. Trump is stimulating the economy back towards a real economy, manufacturing and long-term capex. You never know. This might be the beginning of a multi-year cycle. Then gold could go down.
Peter Schiff, any sentiment as to where the Fed will head?
Well, I'm going to talk about that tomorrow. But getting into gold, though, I don't think this is a new gold bull market. I think that the real secular bull market began at the beginning of the millennium. Remember, we started the millennium when gold was under 300. So the real secular bear market went from 1980 to 2000, right? When gold went from 800 down to 250, 60, wherever the bottom was. But we had a very good run from 2000 to 2011 where gold went up to close to 1900. And people always want to compare where we are now to where we were then to think, well, gold's going down. No, it's not. I mean, gold's gone up over the last 19 years from under 300 to almost 1300. And when gold started to go down, that is when the Fed first started to hike rates. And it bottomed out at 1050 in December of 2015. Now the Fed has stopped raising rates, right? And obviously the next move is going to be down. The only question is, when do they cut? But I would say that gold bottomed when they started to hike rates, and the tightening cycle is over, and gold went up. Exactly. And now we're going to have a next easing cycle, and if gold went up to 1900 during the last one, imagine where it's going to go next time around. Because so many people, of course, when people first bought gold, when they bid it up to 1900, there was a lot of skepticism, warranted skepticism, that QE was going to be a disaster, that this was just inflation and the dollar was going to lose value. That was the right sentiment. But the people who bought in at that stage had bought into a big rally, right, forgetting that gold had gone up so much. It was overbought. But then all of a sudden, the world got overwhelmed by this idea that what the Fed did actually worked. And like, oh, all the people who were worried about inflation, oh, they were wrong. There is no inflation. This is great. You know, and so everybody dumped out of their gold. All the people that chased it to the top, they dumped out of gold and they got back into U.S. stocks and they got back into real estate, whatever they did. But I think what we're about to find out is that the people who bet early on inflation bet right. They just didn't hold on to their hand long enough. They got bluffed out of the market, and I think that was the true move. That was just a small taste of what's going to happen when the Fed has to go back down to zero and does QE4, which is coming. I'll talk about that tomorrow. But that is going to really launch this new phase of this bull market to new highs. And I think gold's going to end up going much higher. Remember, I used to think it would go to 5,000, but that was before, you know, all this stuff happened. So I think that's kind of the low end of where I think it's going to go at this point.
Peter or Frank, do you?
Well, I think that right now where the 50-day is going above the 200-day, and that's the golden cross, and that gets lots of coverage of sentiment that the trend is your friend. But I think it can sort of complement what Peter's saying is I speak to a lot of CFA societies, and it's amazing to see how anti-gold they are. And I love putting up the visual again, showing since the year 2000, gold has far, far outperformed the S&P 500.
Why do you think there is that anti-gold sentiment? Where does it stem from?
It comes predominantly out of, I find out of New York. I've been for my 40 years going back and forth, and I see now with the CFA Society, you know, when they speak, they look at gold as some archaic asset class, and it's always, it's just ongoing. And so you have to go to Asia. If I go CNBC Asia, they're very bullish and want to know about gold as an asset class. CNBC New York, it's a 2-minute trade. Otherwise, you're a gold kook.
And you know, the guy, Frank, the guy that I was talking about that I saw on CNBC was also a CFA. And by the way, not only have they banned me on all CNBCs. I used to do CNBC Europe, Asia, and regular. I haven't been on in at least 2 years. They won't even let me on because I'm, you know, I'm bullish about gold. Although maybe it was also because I was bearish on crypto, and they kind of got the crypto bug near the highs, and they didn't like people coming on that were raining on that parade.
Roy, I know you spent a lot of time in New York. Do you feel there's that?
Yeah, so I used to run a hedge fund, and I was trained by people that hated gold too, and it's a very long conversation, but the simple fact of it, in my view, is people just don't know the basic laws of physics. They're not well acquainted with nature, how nature works, the table of elements, something like natural scarcity, crustal abundance. The reason that, say, if you go back to the first objectively dated, written document, which is called the Code of Ur-Nammu or the Code of Hammurabi, they were using a gold standard. They were using a gold-silver standard that was 1/60th. So basically the mina, the mineh, the reason mineh is called mineh is that was the term for the gold unit, was basically 1/60th, the silver was 1/60th of the gold. And if you look at the spot price of gold, silver today, it's basically the same. Now, why is it? Why don't we use copper? Why don't we use oil? Why don't we use abstractions of the mind like fiat currency or other things? Because over time, what we find is there is a natural order, and there is something called entropy, and things go up and things go down, and things rise and things fall, and things generate and things degenerate. And that's entropy, and things rot and evaporate and tarnish. But then there's this thing that, for whatever reason, called gold, is the rarest and lasts forever. And that's what money is. Money is the baseline for all economic cooperation. Now, when you get taught the CFA test, you don't get taught that, because the basis for human cooperation is stable money. That's the social contract. But the citizenry these days is so stupid that they willingly part with their labor and their goods and their toil for paper. One paper says 100, one says 50.
Yeah. I think the CFAs too fail to appreciate the safety of gold or the preservation of purchasing power. I mean, they think you talk about a 7% annual return, but on a risk-adjusted basis, people who have been buying gold for the last decade have taken a lot of risk than people who have been buying overpriced stocks. I mean, stocks could fall a lot more than gold. I mean, stocks can go to zero. A company could go bankrupt. mean, gold's always going to have value. So people don't appreciate the amount of risk that they've been taking to get these, excessive returns, and that could be lost very quickly. A lot of the paper returns on stocks can disappear quite quickly. Imagine where the U.S. stock market would be right now if the Fed hadn't come in and rescue it.
I remember talking to a regulator years ago. They were saying how risky gold is. And I said, well, that's just not true. It has the same DNA of volatility as the S&P 500. And gold stocks have the same DNA of volatility of biotechnology stocks and emerging market stocks.
I'd like to say something about that. So, by the way, that's another great sleight of hand, and I'm a nerd about these things, so I want to mention it. The S&P 500 is fake. It's an index. It's a spreadsheet. So they basically rotate. There's a formula. It's a very long formula if you ever want to read it. And every time they change the weightings, they just change companies. But when they announce it, you as the market participant have to time that announcement. And then so what you have is S&P index funds, which are for-profit companies trying to mimic the S&P. Now, there is no track record that goes back even 50 or 60 years. I've checked this. There's one fund that you could have bought maybe 70 years ago called the Massachusetts Investment Trust, and it's gone down 90% relative to gold. Because over time, it becomes very, very difficult just to protect your wealth. Now, what's special about gold is that this bracelet could have been given to you by your grandmother 100 years ago, and it's the same unit of gold in your hand. You can't do that with any other commodity, and you can't do that with any other stock.
Well, plus you could melt that bracelet down and start all over. I mean, that's the beauty of gold, is that when people talk about a store of value, what you're storing, the value that you're storing in gold is all the things that you can do with that metal. You could use 1,000 years from now. You dig that bracelet out of the ground, you could do whatever you want with gold. It never loses any of its properties to do anything you want over time. That's the value that's being stored when you're talking about a store of value.
And again, you can hold gold as part of your portfolio. The analysts since the 1970s, when I got into this business, have been saying hold 10% of your assets in gold. Just follow that up with one further sentence. Again, gold is in your portfolio as an asset. Could be the same as your Apple stock, could be the same as your 30-year bonds, could be part of your real estate portfolio. It's part of your entire portfolio. You don't just buy it and forget it. I mean, you can actually manage it. So if you wanted to have 10% of your assets in gold, let's say you got in at $800 and in 2011 gold was at $1,900, I pretty much guarantee you that your gold position was more than 10%. So if you were going in with the psychology that you wanted an insurance position of 10% in your portfolio, you need to liquidate some of your gold when it's at 18% of your portfolio. Vice versa, had you sort of bought into the game in 2011 and bought in at $1,900, 3 years later gold was at $1,000, your 10% position in your portfolio is probably now 4%. You've got to buy that 6%. You've got to have a plan, and you focus your plan. And what that'll let you do is it'll let you liquidate gold into a rising environment and buy gold into a dropping environment.
This is a great point. In fact, that's how I manage my net worth. I keep a naive allocation to gold. That's my money. And when it rises, I adjust it. And I always measure everything in gold. Even our public company, Gold Money, we measure our net worth in gold. And I think the measurement of things in gold is just as important as the naive allocation. But Peter's absolutely right.
Yeah, if your gold goes up in value relative to stocks, that's your money. Now you can use your money to buy more assets. You can buy more stocks, you can buy more real estate. But you're talking about, there was a tradition at one time in America where that was prudent, where portfolio managers would have 5 or 10% of their portfolios in gold. Maybe even into the early to mid 1980s, that was commonplace. I would say today that the average weighting is probably 0. I would say most pensions, most endowments, most funds, they have no allocation to gold. I mean, if they have a hedge at all on their portfolios, maybe they have some kind of levered product or they're in some kind of option position, but nobody has any gold. Imagine what the price
except for the Texas teachers pension.
Yeah, I mean, where do you think
they own, and they have Frank, built their own vault?
I mean, even if the average portfolio manager in the world decided they'd take a 5% position in the price of gold, what would the price? I mean, where would gold have to be to allow every portfolio to allocate 5% to gold? Yeah.
I call it the 10% golden rule. That you should have 10% of your money into gold and gold jewelry and in gold stocks. and rebalance
Yeah,
once a year.
But in order to accommodate that, imagine where the price of gold would have to be, because nobody is buying it and it's at 1,300.
I have another point on this. You should also always average into gold, commensurate with your savings. Think of it as a savings mechanism. So every month you're making a little bit of money, that surplus you can average into gold. The price does have a volatility range, and as Peter said, the price discovery these days isn't real because most of the world isn't cooperating under this system. They're cooperating under the fiat money system. So you can have this convexity where all of a sudden gold goes up a lot out of nowhere. But if you average in over time, you do very well.
And all you guys in the room here, I want to recommend that you buy a little gold jewelry before you take a big slug in a gold stock. Because if you're wrong on the gold stock, your wife will still deal with you in a positive way. And so make sure you get 2 for 1.
Yeah, I wanted to mention, as far as, one of the problems that gold had for a while as money, it was competition with fiat, because there was a relatively high rate of interest that you can earn, real interest rates that you can earn on your deposits of dollars or euros or whatever currency you had, and gold didn't have a yield. In fact, there was a cost to store it. But now, with the amount of debt that the world has, they have to keep interest rates so low to sustain it that almost every major currency, you have negative real yields, whether that's, in some cases, the yields are actually negative in a nominal sense. But even in the US, all of our yields are still negative when you take into account inflation. And so when you have gold versus negative yielding paper, gold actually has a higher yield than all of the debt instruments denominated in fiat currency. So that is something that didn't exist in the past. And so that makes gold a lot more usable as money. And then Roy's other company, Gold Money, ultimately can make gold even more usable as a medium of exchange by taking advantage of the internet and other technologies to make it easier for people to transact in gold, much easier than it used to be when you had to lug around, coins or bars. The fact that you can transfer ownership on the internet, not only does it have a higher real yield and a better store of value than fiat, but potentially it can be used in commerce just as easy.